In today's video, we're breaking down a major development in global crypto regulation. The Basel Committee, the world's most powerful banking regulator, is rethinking its strict 2022 crypto rules after huge pushback from major economies. This shift could massively impact stablecoins, global banks, and the entire digital asset ecosystem. Let's dive into what's changing, why global regulators are disagreeing, and how this could shape the future of crypto adoption at an institutional level. The Basel Committee on Banking Supervision sets international rules for how banks manage risk. Back in 2022, they introduced extremely harsh crypto rules. All crypto exposures were given a 1,250% risk weight, meaning banks basically needed to hold the same amount of capital as the value of the crypto they touched. This put crypto into the highest-risk bucket, making it almost impossible for banks to offer stablecoin services, tokenized deposits, or crypto custody without locking up huge amounts of capital. But now, the committee is preparing to revisit those rules. The biggest reason for this reconsideration is the explosive growth of regulated stablecoins. Global stablecoins like USDT and USDC have become essential in payments, cross-border transfers, and digital financial markets. Basel Committee Chair Eric Fedin admitted that these assets now play a much larger role in everyday financial infrastructure. Because of this shift, the committee believes that their original high-risk assumptions need to be updated. Fedin said they need to start analyzing this quite quickly, signaling that change is coming sooner than expected. A major reason this rethink is happening is because the world's biggest economies are refusing to follow the 2022 rules. The U.S. Federal Reserve has openly said it will not implement Basel's crypto capital requirements in their current form, arguing they unfairly punish innovation. The Bank of England has expressed the same stance, refusing to adopt the framework as written. The European Union adopted some parts of the standard, but specifically rejected key elements relating to permissionless blockchains. This growing divide proves that global regulators are no longer aligned on crypto, and that puts pressure on Basel to adjust. This regulatory divide has huge competitive consequences. If banks in the US and UK operate under lighter rules while European banks remain under Basel's strict version, the advantage shifts sharply toward the more flexible jurisdictions. That means American and British banks could become global leaders in stablecoin payments, tokenized assets, and digital deposit products, while EU banks lag behind. Basel's fear is that uneven rules will create a global imbalance in financial innovation. So revisiting the framework is also about keeping the playing field level. The Basel Committee is now preparing to revise the 2022 crypto rules, especially around risk weighting for stablecoins and tokenized assets. But the process won't be easy. Fedin admits there are so many different views inside the committee, ranging from extremely cautious members to those who want to encourage digital asset innovation. Still, the rapid growth of stablecoins and the refusal of major economies to comply means Basel will likely have no choice but to update the framework. What they decide next will influence how quickly banks around the world can enter the crypto space. To sum it all up, the Basel Committee is officially rethinking its strict crypto rules because stablecoins have grown too big to ignore, and major global powers are refusing to follow the old regulations. A revised framework could unlock stablecoin adoption in traditional banking, accelerate digital asset innovation, and reshape the competitive landscape for banks worldwide. The question is, will looser rules drive healthy adoption or expose banks to more risk? Let me know your thoughts in the comments. And if you enjoyed the breakdown, hit like, subscribe, and turn on notifications for more deep dive crypto updates.